everyone. This is the Salty Stock Skipper coming to you live over from Washington, D.C. It's early in the morning. It's only 5:55. Got up, had to take my dog to the bathroom, and I'm getting up and going. And wanted to just give you a quick little video and talk about what the difference between going long, buying, and going short or selling. Selling short, buying long, that type of stuff, and why you gotta be cautious on one more than the other. So let's get into it here. Let's see if I can get sources. Oh, it's turned up way too loud. Let's turn this down a little bit. Hopefully you heard me. I keep forgetting the media sources full blaring when I get up. Once again, Salty Stock Skipper talking to you today about why buying longs is sometimes better than buying short or selling short, and the risks related to that. Now, just a reminder, I'm not a financial advisor. Anything that I tell you is basically just for educational purposes, and you're not supposed to take any advisement of what I'm talking about into your actual trades. Everyone should develop their own strategies, and if you're day trading and being self-driven, as we say in the investment markets, self-driven controls, self-managed of your retirement funds, this is just an educational advisement. And you may already know about this if you're self-driven. If not, it's good for you to know. So what we have is, I'm going to go over here to the screen here. We have buying the market, we have buying the ask, and buying the bid. What is that really quick? So buying the market is what the price is currently at that very second. This is what the price is. This is what you're going to get as long as you hit the buy button, you buy at that price. For the most part, sometimes you get what we call slippage. You hit the buy button, and as soon as you hit the buy button, the price jumps up to like milliseconds, jumps up or down, and you get either a better price or a worse price, depending on where you're trying to go or what your strategy is. And then what you have is buy the ask. It is what the sellers are willing to accept for you buying. And this is just intraday discussion. We're not talking about pre-market or post-market or anything like that. Just intraday. So you can see here, we got some people willing to sell it here. We got we had one jump in underneath. So you can also place it all the way down here, and eventually, if the price continues to drop, as you can see on my cursor over here, it mimics the price on the graph. As if you put it down here and you set it, forget it. Eventually, if the price comes back down there, you're gonna buy it. So just be aware that when you put your ask in, eventually they might get down to your ask, and maybe you want to adjust your ask. Maybe you want it a little bit lower because the price is still dropping. Why get in at a higher price if you know it's going to maybe go back up? You want that difference. Now then you have buy the bid, and buy the bid is you're basically just putting in your bid for where majority of everyone else is currently bidding. It's similar to almost buy the ask, but not quite. I mean, there's some differences between, like right now it's showing the market as being way down at the bottom, right? That's because we're still in the pre-market, and the pre-market is based on the price from the close of yesterday. And if the close of yesterday was down at $2, and before we're even open today, it's up to $2.75, it's still going to show you $2. The only thing with the pre-market is you can't buy you can't buy with market price because the market's not open. You can only use buy the ask, buy the bid, sell the ask, sell the bid at the time. Now, sell market, just the opposite of the buy market. And so you're going to come in here, you're going to look at, okay, where's the market price at? I'm going to buy at that. I'm going to sell at that, excuse me. So let's say I'm holding shares right here. This is $59. I'm holding $25 or 25 shares at $59. I want to sell it during the market. I hit the sell button. It sells at $59. 25 out the door. Now, selling short, and the same for the sell the ask and sell the bid, especially during the pre-markets. So if I'm selling the ask price is right here. I'm gonna be selling that. If I'm selling, or excuse me, selling the bid, you're gonna be buying up the bid right here. That's when you're selling it off. You're buying their bid. This is what they have. They're willing to give you for it, whether it be money. Well, it's money that they're willing to give you for your shares. So so you can sell the ask, or you can sell the bid. Same with here. The bid is the what you're willing to what you're willing to sell it for. And you can usually sell the bid. You can place it anywhere. You can place, anywhere on the line. Excuse me. Keep Sell the ask. You can sell your ask at any time and place it somewhere on here. If you want to sell the bid, the bid's right here. That's what they're willing to buy it up for, and so forth. So sorry, I had to rehearse in my head for a second. So you're buying the bid here. This is the price here. Got it. Okay, easy enough. I still notice my music's still running. Let's turn that off. All right. So why would you want to buy versus sell? Well, I mean, you can sell what we call sell short and have negative shares, meaning you don't have any shares right now and you want to go in the hole or take negative shares because you're expecting the price to go down. So let's say up here you bought it at 59.31, which was the top part. Congrats on you if you did. And then the market starts to tank. It starts to go down, Well, let's say you had 25 shares from $59.31 down to $58.69. Then you go to sell it. What I mean by sell it, you buy shares. You're negative 25, so you have to buy 25. So you buy 25 of whatever the bid is at the time, and lo and behold, you make the difference between $58 or the $59.31 and the $58.70. It's the same thing on the commission side, or the not the commission side, but the buy side and going long. You buy at, maybe you bought down here at 58.47, 58.42, 58.40 almost, and you rode this all the way up to 59.31. You make that difference. You bought low and you sold high. The opposite for that's going long. The opposite for going short is you buy high and you sell short. You sell at the bottom. So you make money going from bottom to up on the longs, and you make money from the top to the bottom going short. Now, the one thing that you got to keep in mind about buying long and buying short. Buying long, let's say I have $5,000, I put it in long. I just want to let it ride. Just let it sit there. Well, it could grow, right? It could grow. But it could also tank. And we've seen companies go broke, they go bankrupt, and they disappear. They're no longer traded on the public market. We've seen them go to zero. So your risk is that $5,000. But, a lot of people don't let it ride unless it's a long-term type thing. So like mutual funds or CDs or bonds, things like that. Now, what's your risk if you go short with that $5,000? It's infinite. Let's say you bought it at, you shorted the market at $20 a share with $5,000, and it goes up 200, 300, 400, 500%, 600%. You're like Nvidia now. You were over $1,000 at one point. Your loss could be infinite. So while going short is, a good way to make money as well, it also comes with a higher risk than going long. That's why you have to manage your risk. You can't just let things ride. Especially when you're playing the stock market. You have to actually monitor it. And the same goes with your mutual funds and everything else. I mean, if you're looking at TQQQ and we go past, let's say we go back to a year ago, why would you want to still be holding here? Right up here. This was back in July 16th. Why would you want to hold that? If you're going to continue, if you're going to drop, if you saw like this type of drop, whoa, we're down, we're down $10 a share already. Well, that's $10 a share out of my mutual fund. What if you owned 1,000 shares? You're down $100. So, actually, maybe more than that. That's $10,000, right? I don't know. Depends on the share price, I guess. But yeah, it can be crazy. Anyway, I gotta finish this up. But as you can see, I mean, if you sold out here on your mutual funds and then bought in down here, you might have a lower average. Maybe you bought in down here, and you don't want to risk that average, but you just start maybe buying up these dips a little bit. You increase your average a little bit, but you're getting extra shares that you could potentially play into when it starts to go high again. So, that's where they talk about buy the dip. That's buying the dip. Don't hold during a massive sell-off. I mean, that's just, in my opinion, you don't hold in a massive sell-off. I mean, you just lose your money very quickly if you do. You should navigate the sell-off and then maybe consider re-entering at a lower price. So that's what I did. I sold out of my shares up here, and then I bought in a little bit, like down here at the 200 EMA, and bought in again just the other day, like right about here. So I'm margining myself, portioning myself back into the market, but it still has a long way to go. I mean, it has a long way to go. I mean, we're still at the 50s, so even then I'm being cautious. I'm not dumping all my money into it. So gotta watch it. So let's look at what's going on today really quick. So from yesterday, we had a recovery. Let's look at the 5-day chart here. Oh, that's not what I wanted. 5-day. So we had the swooshing down, and then we started to come back up. Kind of bounced back and forth here with this vertical V, inverted V, excuse me. Another inverted V, but we went a little further this time. And we crossed that 200 EMA line on the 5-minute. What about the year? See? Across the 5-minute, or across the 200 EMA. We hadn't crossed it except for once way over here. So, and as you can see right now, the market is just kind of warming up this morning even, and it's already starting to go down. We're underneath the 200 EMA. That could be bad. Unfortunately, I can't get in. I don't think I can get in. Let's see. See if I can do a live trade here. Let's just see. Something small. Where are we going here? Where are we going? So you can chase it, or you can just put it up here and say buy the bid. And so buying the bid, I'm buying what they're asking for right there. So let's just see. We're just gonna see if we can get any of this. Nope. Rejected. Doesn't open for me until 7 o'clock. So that's in 50 minutes. So I'm gonna get ready because today could be interesting. Breaking this 200 average could mean that we are dumping everything. And oh my gosh, it is dumping. If I would have saw this last night, I didn't see it in time. I might have considered holding, but I think we didn't dump until we didn't pass the 200 until. Yeah, see, we touched it here, and then we jumped up, but we're down. We're now past the 200, so we're gonna be turning into a bear market, I think. But don't quote me on it. Keep an eye on it. Keep an eye on your stuff. I'd rather sell out early and take a little bit of a loss than let it ride and take a massive loss and take years to recover. Because I can recover on the market a lot faster. So, all right, there you go. That's all I got. Take care. See ya.